Clara Hermit and this is Mould on Markets, our regular look at the financial markets with Investment Director Russ Mould. Russ, how are you?
Very well, Claire, under the circumstances. How are you?
Yeah, you've hurt your back a bit, haven't you?
Slipped a disc loading the dishwasher, manly duties, won't do that again. But good excuse not to now.
Yeah, of course, you'll never have to do it again.
No.
Russ, speaking of other things, what is it that advisors and their clients
I'd like to move on from the back anyway.
Should be thinking about, apart from your back?
Yes, not the back. We're all intent talks about the general election here in the UK on May the 7th. But there's another race for power that's slowly coming to the bubble, and that's the 58th US presidential election. Now, it might seem like a long time away, the 8th of November 2016, as Barack Obama's second term draws to a close, but the leading candidates are already jockeying for position. Now, for the Democrats, Hillary Rodham Clinton's thrown her hat into the ring, and for the Republicans, we've got Mario Rubio, Ted Cruz, and Rand Paul have all said that they're going to run. Others are sure to follow. Jeb Bush, familiar surname, he's likely to run for the Republicans. And since America is the world's largest economy and home to the world's largest stock market, we're all going to need to pay a lot of attention to who might be sworn into the White House come January 2017.
So before we take a look at the runners and the riders, as it were, are there any clear correlations between the US markets and politics?
Yeah, I mean, we've always got to bear in mind that in the end, stock valuations, and I suppose bond valuations as well, are ultimately driven by cash flow and by profits. They're long duration assets, particularly stocks, so a 4 or 8 year stint in the White House in that basis isn't a big deal and probably shouldn't have too much of an impact. But nevertheless, when you look at reforms like Obamacare, fiscal policies pursued by the current administration, and legislation like Frank Dodd, I mean, it would be dangerous to overlook how political leaders can shape sentiment and also influence, the broader economy and earnings of specific industries in particular. Now, I don't want to go into too much detail on Frank Dodd, because it's a book like that. But there is one trend that advisors and clients might like to know, which is the phenomenon of the third year. Now,
tell us what it is.
All right. I'm just too keen.
I'm
just too keen.
Twist your arm.
I know, twist my back as well.
Yeah.
So since the Second World War, the US equity market has always gone up in the third year of a US presidential term, using the Dow Jones Industrials as a benchmark. Now, I know this is Obama's second term, but it's the third year of his second term, and the rule still applies. The chart behind us actually shows the average gain per year of a presidency, going back to Harry S. Truman, who won the 1948 race, and the third year has historically been the best, by miles. Now, the next graphic, that takes a look at just the third year, president by president, all the way from Truman through to Barack Obama, term by term. And even though the Dow Jones is making jolly hard work of it this year, it is still up, just. Why is year 3 such a good idea? I mean, maybe it's just simply a matter of the president initiating vote-winning policies designed to get them a second term or protect their legacy by getting a candidate from their own party. It's as good a guess as any.
Are there any other trends that we should watch for?
Yeah, the fourth year tends to be a bit of a mixed bag, funnily enough. It's not quite so good. But there is one to note in the first year of a new presidency. So looking ahead to 2017, every time we've switched from a Democrat to a Republican, the market's gone down. Every time a Democrat's come in, the market has gained, 7 times in 8. Okay. The exception was Jimmy Carter in 1976. Now, there's no guarantee, as we all know, history will repeat itself. And that's assuming, we might not even see Republican victory. We may see an unusual third Democrat victory in a row. But I guess in the end, why should the market fall when the Republicans get in? Maybe they're ideologically more comfortable with austerity. I guess he's not afraid to do some of the hard work. I don't know. Now, as a final point, there's always a lot more than the vote going on at any one time. Again, earnings and cash flow momentum are vital. Valuation is important, and the level of US interest rates will always have a bearing on where the Dow Jones goes as well.
Yeah, the point about the interest rate's important here, isn't it? Because the Federal Reserve is still deciding whether or not to push through the first increase on borrowing costs.
Yeah, the interest rate hokey-cokey of do we not, and it's ongoing, and yet we're still waiting to see what happens. And in the end, the US market will fall normally when either rates rise, earnings disappoint, stocks are expensive, or probably in the end a combination of all three. Now, the market is pushing back its expectations for a first rate rise to September or even later. Now, it gets really interesting if the Fed delays to 2016, an election year. Now, the central bank is independent, politically neutral, but given the fairly febrile atmosphere you have in Washington already, it might be a big call for Federal Reserve Chairman Janet Yellen to go around, fiddling with monetary policy and trying to cool down an economy in an election year. Now, that said, our final chart does show the Fed has been very impartial in the past and does what it feels is its duty. Now, the graphic shows the movement in the Fed's funds rate during US election years since Richard Nixon's second victory in 1972. And as you can see, the trend, if anything, is up. There is the odd year when they've cut, but overall the Fed has done what it feels it's needed to do.
Okay, thank you, Russ.
Pleasure.
Thank you to you for joining us, and we'll see you next time. Goodbye.